Hi, my name is Matt Ahlborg and I'm a data scientist. Most of the time I apply data science towards researching the utility usage of cryptocurrencies in developing markets. I put my Twitter on the right first because I'm most active on Twitter, but you can also reach out to me on LinkedIn if you want to. So today we're going to talk about Bitcoin exchange rates in developing countries. First, I'd like to talk about my website. So it's called usefultulips.org. In the middle, I kind of release heavy research pieces a couple times a year. On the right, occasional tweets, data-driven tweets, but most importantly on the left, I actually follow the Bitcoin trading activity of two of the most popular platforms in the developing world, and those are Local Bitcoins and Paxful.com. So if you clicked on one of those, you'd be brought to a page that looks like this, where you follow the volume trends over time. So on this heat map, for example, Southeast Asia is having a strong volume week, while Eastern Europe's kind of having a decline in their volume during the week. And you can see the scale of the volume per region here, and they're all stacked up on top of each other here. You can also drill down on particular regions, so you can see all of the Latin American currencies trading. And Venezuelan Bolivar is #1 in Latin America. And further down the page, you'll see that I actually break out the trends by currency. And if you clicked on one of these in particular, it would bring you to a page that looked like this, where you can look at the volume of a given currency and different date ranges and extra data layers and stuff like that. So this website is hosted from Google Cloud Platform. I have Python scripts running a cron job on a nightly basis. So they pull records from Local Bitcoins and Paxful, throw them into a database, generate charts from the database there using the Plotly charting library. Pelican static website generator converts it into raw HTML, and then it's thrown to the website. So that's that for the website. More recently, I've been really focused on looking at the price at which Bitcoin trades against local currencies around the world. So Local Bitcoins is kind of like a Craigslist for Bitcoin trading. People can come and offer to sell Bitcoin, and they can set their own price that they want to get for it. And so it's a free market rate on Local Bitcoins, which is actually in contrast to the exchange rate of many of the currencies around the world, where they're actually fixed or controlled by the government. So this next chart here, I actually do plot out the official exchange rate of the Argentine peso. It's controlled by the Central Bank of Argentina. I get that from openexchangerates.org. And I plot it alongside the informal exchange rate, which I'm deriving from localbitcoins.com. So to put it really simply, on December 31st of 2020, $1 could get you 84 pesos on the official exchange rate. But $1 worth of Bitcoin can actually get you 165 pesos. You can see that it's trending upward, it's diverging from the official over time. And so I can do this with any currency on Local Bitcoins. So I kind of have this awesome dashboard getting ready now for all the currencies. But the idea, another idea that I had was that perhaps this informal exchange rate has some sort of predictive power on the direction of the official exchange rate. That is, like, if the informal rate is shooting up a couple days before, then maybe that indicates that the official exchange rate is going to have to be pressured to also increase. So to start off this experiment, I created a baseline ARIMA model with the official exchange rate only, not including the unofficial. So I played around with different models, but I settled on an autoregressive lag 2 model, so 2 days lag, integrated or differenced 1 time, with the moving average or error lag of 1 day. So these are the 3 features of this particular model, and they all have coefficients that are non-zero, which means they have signal on the model, and their confidence intervals are also are not touching 0, and thus we can say that these are statistically significant features. Down here, you have a scoring metrics of AIC and BIC, and you can compare those to the next model called the Remax model, which does add a 4th feature, which is that informal exchange rate that I was talking about before. The informal exchange rate also has a non-zero coefficient, and its confidence interval is not touching 0, thus it is statistically significant signal as well. You can see here that the scoring is improved upon the base ARIMA model, and so that's a good thing. That means it's fitting our narrative that the informal exchange rate may have a predictive power upon the exchange rate. So I lined up the two compared models against the actual observations of the exchange rate, and here it's zoomed in. So you can see that it kind of does track it, but not perfectly. The mean squared error for the ARIMA model, the base model, is 0.5, and the Remax model is slightly smaller. So that's again a good thing. It means that my thought experiment is actually fitting the narrative here. So lastly, I want to say that while I focused on the Argentine peso, the Bitcoin actually trades at a premium in many different jurisdictions around the world, and thus you could reproduce this experiment for those as well. And you could use these to trade on Forex markets and actually make money potentially. So if you want to continue following my research, you're free to follow me on Twitter, catch up with me on LinkedIn, or go to my website. Thank you.